Right, let's jump straight into this explainer and solve one of the most frustrating, frankly shocking financial hurdles that millions of Indians are facing right now. Look, if you've ever tried to send money overseas recently, you know it's just not a simple bank transfer anymore. It's morphed into this incredibly complex maze of rules, limits, and, most alarmingly, unexpected tax deductions that can honestly make you want to cancel the transfer altogether. So today we're going to unpack exactly what happens the second your money crosses the border, completely demystifying the Liberalised Remittance Scheme and that notorious 20% tax collected at source.
So picture this. You're sending money abroad. Maybe it's for your kid's university tuition. Maybe you're funding a big family vacation, or perhaps you're making an overseas investment. You initiate the transfer, and then boom, you look at your bank statement and you absolutely panic because there's a massive 20% deduction staring back at you. It feels exactly like an unexpected fine just completely out of nowhere. And trust me, we see this exact panic all the time from people who feel utterly blindsided by their own banks.
Which naturally leads to the most frantic question we hear. My bank just deducted 20% TCS. Is that money gone forever? People literally believe a fifth of their hard-earned cash has just vanished into the government's pockets as some sort of penalty. But hey, take a deep breath. Consider this your financial rescue mission. We are going to show you exactly how this system actually works, and most importantly, how you are going to get every single rupee of that money back.
Let's start with Section 1, the baseline rule. Understanding the Liberalized Remittance Scheme.
Okay, before we even touch the taxes, we absolutely have to understand the container that your money lives in. Every dollar you send out of the country legally falls under a framework called the Liberalized Remittance Scheme, or LRS for short. The precise wording here is absolutely crucial. This is a Reserve Bank of India framework that lets you send money abroad for permitted purposes. Think education, travel, medical treatment, without having to beg the RBI for approval every single time. But here's the kicker. This scheme is specifically designed for resident Indian individuals. That actually includes minors, assuming it's processed through their parents or guardians, but it explicitly excludes companies, partnership firms, and trusts. This is strictly a personal, individual financial tool.
And here is the magic number, $250,000 US. Every single resident individual in India is allowed to send up to a very generous $250,000 abroad per financial year. And remember, the Indian financial year runs from April to March. Because this limit resets every April, strategic timing is literally everything. If you're planning a massive overseas purchase, splitting the transaction across late March and early April lets you effectively double your remittance capacity in just a matter of days.
All right, moving on to Section 2, your actual TCS rate. Breaking down the tax collected at source tiers.
So, that terrifying 20% rate you always hear about, it is actually not universal. It entirely depends on why you are sending the money. Notice the huge differences here. If you're funding an overseas education using a formal loan from a financial institution, the TCS is a tiny 0.5% for amounts over 7 lakh rupees. If you're self-funding that education or paying for medical treatment abroad, it jumps up to 5%, but again, only after you cross that 7 lakh rupee threshold. Now, overseas tour packages hit a 5% rate right from the very first rupee. But for almost everything else, like investments, sending gifts, or maintaining relatives abroad, that is exactly where the 20% hammer falls on amounts above 7 lakhs. So figuring out exactly which bucket your transfer falls into is your first line of defense.
Now for a quick sigh of relief amidst all these percentages, there is a very important carve-out you should know about. If you are simply swiping your foreign credit card internationally while traveling, the RBI has currently exempted these spends from TCS. It sits at a beautiful 0% rate. This was a massive point of confusion recently, but for now, international credit card swipes dodge the TCS bullet entirely. So, enjoy it while the RBI lets it last.
Okay, Section 3, the rescue. Getting your money back via ITR.
So you've made the transfer, and despite knowing the rates, the bank went ahead and deducted the TCS. It feels like a massive loss, I know. But here is the absolute biggest myth we need to shatter right now. TCS is not a penalty. It is not a sunk cost. The reality is, you've essentially just been forced to give the government an involuntary, interest-free loan until tax season. TCS is literally just an advanced tax credit sitting in a government ledger waiting for you to claim it. You can completely adjust it against your total income tax liability for the year, or if you don't know any tax, you can claim it as a direct cash refund right back into your bank account.
Actually getting that money back comes down to a super simple 3-step playbook. Step 1, your authorized dealer, which is just banking jargon for your bank, deducts the TCS at the exact moment you make the transfer. Step 2 requires just a little bit of patience. You need to wait about 30 to 45 days.
That's exactly how long it takes for the bank to deposit your money with the government and for it to officially show up in your Form 26AS or Annual Information Statement. Step 3 is your final move. When tax season rolls around, you just claim that credit or refund when you file your income tax return. It really is that straightforward.
But wait, this is an absolutely critical warning. While this tax credit technically doesn't expire, the only way to officially unlock it and claim it as a refund is by actively filing your tax return. If you're someone whose income is below the taxable threshold, say a retired parent sending money to a child studying abroad, and you think, well, I don't need to file an ITR, your TCS credit will just sit there, permanently wasted. You absolutely must file the return to get your money back.
Let's pivot to Section 4, the big NRI misconception. Who can actually use this scheme?
We see a massive amount of search traffic and confusion from the global Indian diaspora on this, so let's clear the air once and for all. Non-resident Indians simply cannot use the Liberalized Remittance Scheme. Why? Because the very first word of the scheme literally dictates it is for resident Indians. If you're an NRI trying to move money out of India, you're governed by entirely different FEMA guidelines, and you have to use your NRE or NRO accounts. However, the flip side of that is also true. If you are a resident Indian, you absolutely can use the LRS to send money to your NRI children or relatives living abroad. It's the residency status of the sender that completely dictates the rule here.
Finally, Section 5, Rapid-Fire Realities, busting the final LRS myths. To wrap up the mechanical gears of this whole scheme, let's do a quick rapid-fire sweep of the most common mistakes that end up triggering regulatory audits. First up, that $250,000 limit is cumulative per financial year, meaning you can't just send $250K on a Monday and then another $250K on a Tuesday. Second, your limits are strictly individual. You absolutely cannot club your limit with your spouse to send $500,000 in one single shot. Third, if you own a business, do not try to use LRS for corporate transfers. It is for individuals only. And lastly, going even a single dollar over that $250,000 mark without prior explicit RBI permission is a direct FEMA violation. Just don't risk it.
So, we've completely demystified the LRS limits, broken down exactly how the TCS tiers are calculated based on your purpose, and proven that this deduction is absolutely not a penalty, but a fully refundable credit. Now that you have this entire roadmap, the only question left to ask is this. Are you going to file your ITR and claim what is rightfully yours, or are you perfectly happy leaving a 20% tip for the government? The choice, and the cash, is entirely in your hands.